Thank you for joining me for a data-driven look at inflation in the stock market. The news on Wednesday was at first considered to be bearish for stocks. Inflation was higher than expected. Core inflation, which excludes the volatile food and energy components, was also more than expected. Year-over-year core inflation up 1.8%. Fed's target 2%, so we're getting close. And the Fed remains on track now to raise rates probably 3 times this year based on the inflation reports. Well, traders obviously sold first and read the report later. This is a 5-minute chart. And as you can see, stocks plummeted on the news. But as traders read the details, they realized the report wasn't so bad after all. And stocks rallied then throughout the trading day. This is the S&P futures because futures trade outside of traditional market hours, and it shows us the instantaneous reaction which occurred at 8:30 Eastern Time. This chart shows the longer term relationship, and the blue line is the 1-year rate of change in the S&P 500. The areas shaded in green are times when the consumer price index was rising at more than 3% a year. As you can see, that was the normal state of affairs for most of this chart, which in fact goes back into the 1960s, and higher inflation had no impact on stocks. If there's a consistent pattern to be seen here, it's that low inflation might not be the most favorable set of conditions for stocks. And what we find is that when the CPI is above 3%, stocks trade with an average PE ratio of 19. Now, when inflation is below 3%, stocks trade with an average PE ratio of 18.5. So it really isn't much different. But right now, analysts expecting earnings for the stocks in the index to come in at about $157. That gives us a price target based solely on the fundamentals in the average price performance of $29.83. We're looking at a potential double-digit gain here in the stock market, no matter what inflation does. So now is the time to remain bullish. Thanks for joining me.